Good morning, everybody. Welcome back to Strongman Personal Finance. We got a sponsored video. Somebody paid me some delicious, superstitious money to talk about a 5 trillion X opportunity in a very small, cute little semiconductor manufacturer known as Skywater Technology. So what's this stock all about, and why could it possibly 5 trillion X? Well, Skywater Technology basically makes semiconductors. They get contracts for very specialized solutions. Some organization says, hey, we need a semiconductor. We need this. We need that. And Skywater executes a contract, sign a contract, and they go ahead and make whatever the company wants to make. This is a very small company. Okay, this is not Intel or Taiwan Semiconductor or NVIDIA. This is a very, very, very small semiconductor manufacturer. They currently have one foundry fabrication plant in Minnesota. Oh, yeah, from the Midwest. Oh, and they're thinking about building another one. Well, I guess they announced they're going to in Discovery Park District at Purdue. So this announcement was made July 20th, 2022. So they're going to basically, I don't know if they're going to double their capacity, but they're talking about building a new semiconductor fabrication facility in, where is this? Indiana. So they're basically going to almost double their capabilities, depending on how large this factory is. Now, who's the leadership? Well, you got Thomas Sonderman, John Sakamoto. This guy was just promoted to president and COO very recently, and CFO. Now, Thomas, the CEO, he's been here since, I think it was 2017. Since 2017. So he's been around. He's been around a while. Okay, so he's been running the company. I guess it's been going well. And yeah, so let's go ahead and dive into the financials. So the first thing I want to clue you in on is the market capitalization. Very, very small company, like I said. It's got a $270 million market cap on revenue of $253 million. That's our trailing revenue. And net income of negative 22. They are unprofitable. However, they have a forward PE of 222. And analysts are saying it's a strong buy with a price target of $25. Why are analysts probably saying this? Well, semiconductors are all the rage. They're popular, blah, 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 blah. Semiconductors are the future, bro. So there's an opportunity here, okay? It could happen. I'm not saying it couldn't, but you got to actually look at the company and understand what you're investing in, okay? There's a reason this company is only $270 million of market cap. Let's go look at the financials, okay? First, we got revenue. So they've been pretty consistently growing their revenue. I mean, they have some fluctuations because basically they're so small that they depend on a couple contracts to really generate growth. Now, they could continue to grow their revenue over time. They could sign more and more contracts with this new facility whenever they build it. I don't know when it's going to be done. They could potentially have the capacity to sign more contracts. So there is a pathway to growth for the company. And they've had pretty consistent revenue growth over time. But there's also risk there because if you only have a couple contracts, you could have a massive drop in revenue at any time. If you don't get if you finish a contract, you deliver it, you recognize all the revenue, and then you can't find a new contract, that's when you could potentially run into some trouble. Okay. But so far, they've had pretty consistent revenue growth. I mean, it's up and down, but over time, it's been going up. So they're a growing company. Let's look at their gross margins. So gross margins are in the mid-20s. I mean, they've improved their gross margins. I'll give them that. They've been improving profitability. They have negative operating margin. Now, look back in 2021, 2022. Pretty negative, pretty bad, okay? But over time, they've started to approach profitability. So they're getting better, slowly but surely. But this is still a money-losing company. Still a money-losing company. And when you invest in a company like that, you know right off the bat, when a company's losing money and they're burning cash, they're going to either have to dilute at some point, issue shares, or they're going to have to pack on debt. That's the only way a company can continue to generate cash if they're not making cash from their core operations. All right. Profit margin's obviously negative, and free cash flow, that's after interest and taxes. And they have negative free cash flow margin. We'll go look at their balance sheet on their actual financials. Cash flows over time, they've had very consistent negative operating cash flows. Negative, 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 negative. A little bit of positive one quarter, but basically negative. This is a money-losing, cash-burning business that has a few contracts and one facility. Capital expenditures, they don't really spend that much on capital. This is a really small company. Look at this. Very small company. Share issuance, we can see shares are going up. Why are they issuing shares? Because they're losing money from cash. They're losing money in their core operations. Debt, looks like they've, not recently, I guess they had a little bit of a debt issuance in the first quarter of 2023. Actually, a pretty decent amount. But overall, the last year and a half, they've mostly taken on debt instead of paid it off. And other financing activities, whatever. So overall, hopefully you kind of get the picture. This is a very small niche company that has very few contracts and is trying to grow. They're trying to build a new facility, and they're a money loser. And when you buy a money-losing business, you might get clapped, okay? This has happened over and over and over again. Let's look at the stock price over time. Okay, the stock price went up pretty significantly in 2022. Oh, chips, bro. Just buy chips, bro. Chip stocks, bro. And then the stock price absolutely collapsed. So we're currently at $5.84. Now, let's go ahead and look at the balance sheet. So this is their most recent condensed consolidated balance sheets. Why is it balance sheets? Well, they probably have some subsidiaries that they're combining into the balance sheet. So cash and cash equivalents. Cash went for the 6 months between January 1st and July 2nd, 2023. Their cash went down by $15 million. How much of that was from operations? Let's see. No. Yeah, so they burned $18 million in operations. So basically, a big chunk of their cash burn came from losing money in operations. Accounts receivable is up. So that means there's more money owed to them. Inventories are up a little bit. Prepaid expenses, no real change. Basically, their current assets have not changed that much overall. They burned a lot of cash from operations, but they're expecting to collect more and more receivables, at least from January 1st, 2023. So total current assets are $118 million versus current debts of $130 million. Okay. That's okay. So the current ratio compares, it looks at liquidity. It compares current assets, money you have now or are about to collect very soon, versus debts that are due within a year. Now, they're short-term debts. They have a little bit of current debt due. Accounts payable, that's normal business expenses. Accrued expenses, these are expenses that you've incurred, but you haven't yet paid yet. Short-term financing, look at that. They're borrowing money. They are borrowing money. $54 million of short-term financing. Why? Because they're burning cash and they need to freaking borrow it. They're not making money from their core operations. And then about $27 million is deferred revenue. So their current. So when you look at deferred revenue, you've been paid up front with cash. You just haven't performed the obligation yet. So if the contract isn't canceled, they're eventually going to collect. They're going to be able to recognize this revenue on their income statement. So if you look at their current ratio, excluding deferred revenue, which is just obligations they have to do in the future, it's a little bit better. They have more current assets versus current liabilities if you exclude deferred revenue. All right, let's look at long-term assets. Property, plant, equipment went down. It's depreciation. Intangible assets went down. That's amortization. And other assets, pretty insignificant. So they have roughly $180 million of long-term assets, and they have long-term liabilities of $105 million. What are their long-term liabilities? Long-term debt. Okay, they have a lot of deferred revenue and long-term liabilities. Like I said, that's stuff they have to do, and when they do the work, this is their contracts. When they do the work, they can then recognize the revenue on their balance sheet or on their income statement. Excuse me. So overall, their long-term assets versus long-term liabilities really isn't that bad. What's more concerning is their current debt. They owe $54 million on short-term financing that's due within a year. I would be more concerned about this company's liquidity rather than its solvency, rather than the business being massively underwater for long-term debt versus long-term assets. I would be more concerned about their current operations because they're burning cash and they're borrowing money to sustain themselves. Okay. So, but they have a lot of deferred revenue on their long-term liabilities. And it's a liability because you still have to do the work. That's why it's a long-term liability. So overall, the balance sheet's okay. I mean, like I said, I'm a little concerned about this short-term borrowing and this cash burn that they're going through. They're probably going to issue shares. Okay. Common stock, we see stock has gone up. They're issuing shares. How much stock did they issue? They issued about 2 million shares. So what? A 4% increase, something like that. Let's see, 45.3 divided by 43.7. Okay, so they've increased in 6 months. They've increased their share count by almost 4%, 3.6%. So they're issuing shares to stay afloat. Okay, they have an accumulated deficit of 107 million. So basically, all the equity in this company came from borrowing or from issuing shares. That's all. It's where all the equity came from. Accumulated deficit is their total cumulative losses over time. So since the life of this company, they have lost $107 million on the accrual basis of accounting. That's something to consider there, okay? Let's see. So they're looking at their blah, 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 blah. This is their income statement. So revenue, cost of revenue. R&D spending year over year is basically the same, but their selling, general, and admin costs have actually gone up pretty significantly. Look at that. But even though that happened, they still were closer to profitability. We also see their interest expense went up. It almost tripled. Their interest expense has gone up massively. Why? Interest rates are higher. So they're borrowing all this money to meet their short-term needs, these credit facilities that they have, and they're paying more and more interest. So over time, that could really start to hurt their margins. If interest rates stay high for a long time, this could be a big negative for the company. So keep that in mind. That could really affect the company negatively. Yeah, I mean, really nothing crazy. I mean, they've grown their revenue pretty significantly year over year, and they've improved their margins a little bit. All right, let's go look at their share issuance. Okay, so why are their shares being created? Well, between January 1st, 2023 and July 2nd, 2023, they issued $1.1 million or 1.1. Okay, that's 1,156 shares that they issued for what? $12,000. Okay, no, that's a million. Sorry, 1.1 million shares, and they got $12,000 for that. That's issuance of common stock. That doesn't sound right. Okay, so dollars and shares in thousands. So they're saying they got $12,000 on 1.1 million shares. That doesn't seem right. Maybe I'm reading this wrong, but they're definitely issuing shares, okay, mostly to finance their operations. And a decent chunk of the shares they issued went to equity compensation plans. So that's like stock options and stuff. All right, cash flows. Let's see. Yep, increasingly negative cash flows. A big part of that was accounts receivable, changes in current assets and liabilities. Let's see. Inventories, deferred revenue. I mean, provision for credit losses. Look at this. What is this? So they had a pretty significant, so they're starting to record provisions for credit losses. Maybe they aren't going to be able to collect money that they thought they were going to collect from one of the people they had contracts, one of the companies they had contracts with. I would look more into that about why they're now recording a provision for credit losses, because that's pretty significant right there. That's $3.6 million of credit losses. Let's see. Stock-based compensation's down a little bit, but it's pretty significant. It's about $3.8 million on the income statement. All right, draws on revolving line of credit. They're borrowing money. Look at that. Borrowing lots of money. They paid it all off, or most of it off, but they're still borrowing money pretty significantly. Let's see. And stock. Okay, so that looks like it was 12 million. That didn't make sense. Because I was looking at here, I was like, they got $12,000. It's like, no, they got $12 million for issuing 1.15 million shares. That makes more sense to me. Okay. So overall, let's see. They had their contracts. Let's see. Okay, the following table discloses revenue by product type and timing of the recognition. So total revenue from water services, this is a contract, or if this is something that, wafer services, excuse me, making little wafers. I don't know anything about chips. They made $16 million. Advanced technology services, they made $27 million and $23 million from fixed price contracts, time and materials. Let's see. Most of their revenue comes from the United States. They have a couple contracts with some company in Hong Kong, Canada, United Kingdom, but basically the vast majority of the revenue comes from the United States. And customer concentration. Now, this is what I was talking about. Customer A accounted for 21%, it looks like, of their revenue. Customer B, 18%. Customer E, 13%. So you can see this company is very concentrated. Okay, if they can't keep getting new contracts, they're going to run into trouble. That's the risk with this company is they can't keep generating contracts. Because if they don't, you're going to see a pretty significant decline in revenue. So that's something you really got to pay attention to do, too. Okay. So overall, I mean, this is not my type of company. You know, I'm not saying this company couldn't have massive returns in the future, but it's very small. It's losing money. It's very dependent on a very few contracts. They're thinking about making a new plant, but we don't even know when that's going to happen. There's a lot of risk in this company. Okay, that's all I'm going to say right there. But that's basically Skywater. It's a very small niche company. Really not much more to talk about. All right, let's do some comments. Hello? Come here, buddy. Let's go do some YouTube comments. Then we're going to cut this video off. Yeah. Yeah. Good morning. Woo! Anything could 500x, but must be worth looking at. See, that's all you got to do in finance is you just, it's going to 500x. And everybody will just throw money at you. Like Kathy Wood. Oh, it's the future, bro. Does live stream pay more than regular video upload? I mean, it's the same, basically. It's like $5, $10 a video. Oh, yeah, that's right. I don't make any money on YouTube, Alan. Most of the companies that these 10x by 10x YouTubers talk about are money losing. Of course they are. Because companies like that, they either crash and burn or they, suddenly turn themselves around and make a lot of money. You're famous. There's 20 people watching you, Alan. Can you talk about businesses that sell products at Walmart so I can do my stock analysis while I shop? Absolutely. Everything is going down next week, but oil and defense stocks. Still buying VT. Invec is also small, but a great semiconductor company. I have not even heard of that. Best dad ever. I know. I'm a great guy. I'm a hero. Little Strong, man. Say hi, Alan. Say hello. Say hello. Say hello. He doesn't even know he's on camera right now. He doesn't know what's going on. Little Strong man can beat the returns. Oh, yeah, 100%. It's not hard to beat ARK. Hello, can you look at Intel? Yeah, for $50. These kids are expensive. All right, that's Skywater. I mean, interesting, I guess. Maybe it has some potential, but not something I would invest in personally. So, all right, we'll do a LaFufu outro, and you guys have a wonderful day.
Mama.
Where is Mama? Yeah, go to Mama. Go find Mama. Whoop. Go find Mama. Don't eat that. No. Jesus. All right, talk to you later. Cheers.
Oh, merry stock market. Oh, man.